Today we're looking at a financial analysis on Plug Power.
A really deep dive.
It argues there's a perfect storm brewing. A short squeeze, new liquidity.
Right. The title asks if a parabolic move is coming.
And I think that's exactly where we should start. The tone. The report's use of really urgent, almost hyperbolic language, especially that word parabolic. It might actually hurt the credibility of what is, a very strong thesis.
I see that too. You read parabolic move, super squeeze, the trap, and it feels like it's trying to sell you something.
Exactly. But then you dig into the numbers, the actual analysis.
And it's solid.
Very solid. But the first major resistance target they list is what? In the 3 to 350 range?
Yeah, from a base of about 220.
So we're talking about a 35, maybe 60% upside, which is fantastic.
It's a great short-term trade, absolutely. Especially with that December 12th record date catalyst. It's very actionable.
But it is fundamentally not parabolic.
Not even close. And that word parabolic, it's just a huge red flag for any, sophisticated reader or analyst.
Uh-huh.
I mean, doesn't it create this disconnect between the promise in the headline and the actual measured expectation in the report?
It does. It absolutely does. A serious reader is looking for rigorous data, for measured confidence.
Not marketing hype.
And when the headline screams one thing and the numbers whisper another, it just erodes trust. You start looking for other problems.
Even if the data is sound.
Yeah.
You start to doubt everything else.
It deserves.
The mechanics of the squeeze. The record date forcing shorts to cover. That's compelling on its own. It really doesn't need all the extra adjectives.
So the suggestion is basically to anchor the language back in reality, but keep the conviction.
Exactly. Strengthen the report by recalibrating the language. Frame it as a high-conviction revaluation opportunity.
A revaluation, not a rocket ship.
Right. Let the facts drive the excitement. I mean, that headline, is Plug setting up for a parabolic move? Rocket ship. It just screams marketing first, analysis second.
So what's a practical fix? How do you keep that urgency without the hype?
You focus on the catalyst. Make it specific.
Okay.
So instead of the parabolic thing, what about something like PLG, analyzing the immediate revaluation opportunity driven by the December 12 record date?
It's accurate, it's actionable, it respects the reader.
And then you look at the internal labels too. Bear Killer is a great example.
It's punchy. I'll give it that. It gets the point across.
It is very punchy. But for a serious report, maybe something like liquidity stabilization, 399M financing removes imminent solvency risk, just carries more weight.
You lose a bit of the punch, maybe.
You do, but you gain a huge amount of analytical authority. And that seems to be the trade-off that's needed here.
I agree. That alignment of tone is a huge first step. But that leads us straight into the next point, which is about the bigger picture of risk. So while the report just perfectly dismantles the immediate bankruptcy idea, it really needs to bring in a discussion of the other systemic risks that are still out there.
To give the full picture?
It makes it so clear that the $399 million in notes has killed that bankruptcy risk. It sets that floor for the stock, around that 190 to 218 zone. It's really well argued.
It is, but it focuses so heavily on removing that one risk, the liquidity risk, that it seems to downplay everything else.
What are you thinking of specifically?
Well, it mentions EU regulatory headwinds just in passing, right? In relation to that high Tujin deal.
Yeah, it's a quick mention.
But it's not treated as a real constraint. It's not presented as a potential counterargument to how fast or how high this thing could go. And that feels like an analytical gap.
I can see why, though. When you have this one massive positive catalyst taking bankruptcy off the table, it's tempting to just focus on that.
Of course.
But a truly great analysis anticipates the reader's questions. It addresses the counterarguments before they're even raised.
Precisely. The report can be so much stronger if it shows it's aware of the whole operational and regulatory landscape, even if the conclusion is still bullish.
So the question to ask is, does focusing only on solvency risk maybe overlook how hard it is to execute in these global markets? I mean, scaling hydrogen is not simple.
Right. So the suggestion is pretty straightforward. Just add a brief, clearly defined section. Call it remaining headwinds or operational constraints or something.
And you'd put that right after the financing section?
I would, yeah. It shows you've thought through the whole picture, not just the good news.
So how do you do that without suddenly sounding bearish? I mean, it's a delicate balance.
You frame them as challenges the company's strategy is designed to overcome. So for example, with the EU headwinds, you could get specific.
Okay.
Talk about how potential permitting delays or shifting green energy incentives in Europe might affect the timeline for that 5-megawatt project in France. It grounds the risk in reality.
And what about the financing itself? That's not without its own risks.
That's a great point. The cost of capital on those convertible notes is high. You should acknowledge that.
So you say, look, this financing structure, it raises the bar for them to perform.
Exactly. You acknowledge the higher debt burden, and then you pivot and say, but the recent contract wins prove they are executing at a level that justifies taking on that expensive capital.
I like that. It turns a potential negative into a point of strength. It's a much more sophisticated argument.
And it adds a huge amount of trustworthiness to the whole bullish case.
Absolutely. Okay, that's a huge improvement. Now for our last point, let's talk about the structure. Specifically, how the fundamentals are positioned. The analysis does a great job establishing the short-term triggers, the mechanical stuff.
The squeeze, yeah.
But it could be so much stronger if it explicitly linked all of that back to the fundamentals. Frame those as the real long-term driver.
Tell me more about how it's structured now.
Well, it puts the liquidity events and that December 12th record date right up front. They dominate the first half.
Which makes sense. It's the immediate catalyst.
It is. But then the huge operational wins, like the NASA contract, the HyGen deal, they're sort of categorized as fundamental momentum.
So they're treated as secondary evidence, supporting points.
Exactly. Not the core thesis.
Okay, I see. But the report is arguing the stock is mispriced, right? With targets up to $7?
It is.
Well, the reason it gets to $7 can't just be a short squeeze. A squeeze is temporary. The long-term revaluation has to come from the market finally appreciating the underlying asset.
Right. The technology.
The fact that the tech is now being validated by mission-critical contracts. And that point feels a little understated in the current flow.
I get why they led with the squeeze, though. That December 12th date is so immediate, so actionable. You don't want to bury that, do you?
You don't bury it, but you reframe it. It's about shifting the emphasis, not the placement.
Okay.
I think the way to elevate the impact is to use those mechanical catalysts, the financing, the technical floor, as the necessary condition.
The necessary condition for what?
For the stock to stop falling. They eliminate the bankruptcy distraction. They create a floor.
Ah, okay. So the mechanics create the opportunity for the market to pay attention.
Exactly. And then the fundamental contracts, NASA and HyGen, they become the sufficient condition. They're the reason for the long-term price targets.
I see. So it's not just, this is why the stock can go up.
No, it becomes, this is why the market must revalue the underlying business. It's a much stronger narrative.
That makes so much sense. That linkage is what gives the whole analysis legs beyond a single date on the calendar. So how would you restructure that flow?
Well, right after you discuss the liquidity injection, you make the transition explicit. You say something like, now that immediate solvency concerns are removed, the market is forced to recognize Plug's verifiable operational execution.
And then you dive into the NASA deal.
And you dive deep. You don't just say it's a contract win. You explain that supplying liquid hydrogen to NASA's Glenn Research Center is a massive validation.
It's proof of reliability for mission-critical applications.
Yes, it's a huge technical de-risking event, and that is what justifies the argument that the current price is just wrong. It fundamentally misprices this newly validated technology. That's how you connect the short-term floor to the long-term ceiling.
That was an incredibly clear breakdown.